women.
Hello everyone, welcome to episode 5 of
Wealth for Women.
and today we are going to talk about investing.
Hi. So our last episode we discussed about planning for wealth. And this time we are going to talk about investing.
Okay, so let's say I made some money, yeah? What happens if I just leave the money in the bank?
So again, you could potentially leave the money in the bank, but over a period of time, things become expensive, inflation goes up, which means the money is not capable to buy what it can buy today down the line 10 years. So that means we are going to lose value for money. So your money in the bank could stay there. It can also earn small interest if it's in saving account, but often in current accounts you don't earn any interest. But it is over a period of time going to lose its value.
So, as secure as I feel leaving my money in the bank, I am losing a big opportunity to make more out of it.
Yes, exactly. If we go back to our previous episode, talked about planning and putting a vision board in place. So things that we need.
Yeah.
But often our expenses are based on the way we are earning money. We have an income. So we are giving away our time to make money. But what happens when we stop giving our time? So when we want to do things that we want, like our hobbies, our travel plans, etc., we are not able to give our time. That reduces our income. But what we want is to build this investment pot over a period of time when we are able to, so that when we want to relax or do things that we want to do, we can use this income. We can generate the extra. So this is basically our, in a way, a safety net for ourselves.
Yeah.
So
when you grow old or when you fall sick.
Yeah, or if you just don't want to work, right?
Yeah.
You are done with what you're doing over a period of time. You can obviously save money in the bank, but it doesn't grow as much as if you would have invested.
Yes. Let's say I want to invest. Where do I start?
You can start with simple things like ISAs and pensions. So you can get stock and share ISAs and pension. So usually in UK, you're allowed to put £20,000 a year into your ISA allowance, which is the money you can take it out, but once you take out, you lose the advantages. So in ISA, you get the advantage of putting the money in ISA. You get the dividends or interest and capital gains. So you can buy and sell shares there. So the capital gains you're going to have, that is nothing taxed. So it stays in the pot where the money can grow, and this money is always there for you when you need it. And then there's also a pension pot, which you can only take out after you're 55. But again, you can keep investing in this pot. You can't take it. If you take it out before that, you have to pay some fees to HMRC. And when you take that money out after 55, you can take lump sum out, and 25% of that lump sum is not taxed. And the rest comes out as a salary over a period of time.
So these are, let us say, safe form of dipping your feet in the water when you start your investment journey, especially in the UK.
See, the investment is never safe.
Yeah.
There's always risks involved. Obviously, the safest thing could be, there's nothing safe, right? If you say safe, you cross the road, you could be hit by the bus or things. So there is always elements of risk.
Yeah.
So even if you put the money in the bank, can go bust. Plus, the money is going to lose your value. So you have to understand how much risks you are capable of taking.
Yeah.
So nothing is 100% safe, but you need to manage risk. You need to learn to manage risks. And over a period of time, let's say if you buy index funds. So index funds are many stocks they put up together. So they could be like S&P 500 and all. So you have 500 or top 200 companies put together, and that basically spreads your risks over many different stocks. So it reduces the risk. That's I would say. I wouldn't say it's totally safe, but it's much safer than individual
Relatively,
investment.
yeah, I understand. So a lot of it is how your risk appetite of how much of a risk taker you are, and your personality does play a role. I wanted to explore the topic of myths in investing, especially when it comes to women. Do you think that women are more forthcoming when it comes to investing decisions? Is there anything that's holding them back or could do better?
I think women, first of all, they've been told they know that they don't understand much about investment, and they leave the investments to the husbands or the male family members. But there are smart women, there are good housemakers, they do investment. I've seen a lot of ladies, they go and buy properties and redo the property and resell the properties. A lot of women, they buy gold, for example, which is like very traditional thing to do. And it's not really bad because gold does keep go up in the value. So it is a good investment to have. And especially for a rainy day, you always have something to look back at. You can always, nowadays in India, you can give the gold, keep the gold in the bank, and then you can get a credit limit against it. So it is also not bad and was traditionally done. Gold, silver, all the metals, they're not a bad investment either.
Just one question when you were talking. So when you say investment, it's a long journey. Can you give us some advice about how to think about investing short term, mid term, long term in that journey?
So investment is always for long term. It's not, you don't expect to become rich in short term.
Yeah.
If you want to do that, you better do some business or side hustle. But investment is usually for long term. When you invest the money, you leave it there for 10 years or so. So there's a very interesting book written on investments called Intelligent Investor by Benjamin Graham. And it's a very old book. It tells you lots of details into step-by-step instructions, how to look into the shares and how to calculate the earning, the PE ratios of the shares and buy those shares. So there are lots of things about investments that you could do, but they are usually long term.
Long term.
Yeah.
Yeah, so when you think about investing, as you said, could be in gold, it could be in pension funds, but the one that creates a lot of interest is stock market investment. As it's a very volatile market to play in. How do I position myself there?
Okay. So you're right, the stock market goes up and down. And what they say is it's not the timing in the market, it's the time in the market. So that means you don't wait for the stock market really goes down. Then obviously if it does go down, that's obviously a good opportunity, like when COVID happened and things, to invest. But it should be a natural habit. You don't wait for the time to start investment. You need to make investment as a habit. So whenever I ask clients to put monies in ISAs and things, and they're like, we don't have any money. So if you're in a situation when you feel like, what you earn, you just spend everything, you don't have any money, start with anything as small as you can. So something like 50 to 100 pound a month. I'm sure you could afford that much, or whatever you feel is very affordable. Put a standing order into your investment account every month and buy these indexes, or you can find some funds. There are fund managers who can manage funds for you. So you don't have to go and look for each and every stock by yourself. You can pay a small fees for the fund managers to do it for you. And do it every month, because over a period of time, the stock market goes up and down. This average out, over, if you look at it today, okay, the stock market is up and down. But if you look at 10 years time, it just average out your investment. So you still get the benefit of the market
Having been
going
in
up,
the market.
having been in the market. Yeah. So you stay in the market for 10 years than to actually see your results.
Yeah. I'm going to ask you a silly question.
Yeah.
When do I stop investing?
You never stop
I never
investing.
stop?
You never stop investing. So what the money that investment brings to you,
Yeah.
so like your dividends and etc. So those investment gives you power of controlling your own time, right? So you don't have control on your own time because you have to pay the bills and things. But once you have good investment, that gives you power of your own time. You can do things of your own time. So the investment brings you return. Again, you need to look at those returns, how much you're spending on yourself, and you reinvest that money back into the market. Different again, as an investor, you wouldn't keep all your eggs in one basket.
Yes.
So you need to spread your risks.
Risk, yeah.
So it could be property, it could be shares, stock, gold, etc.
When you have an investment pot, yeah, and you assign a percentage to each of the pots, yeah, property versus gold versus bonds versus pension plans, where do I keep the most number of eggs?
Again, you don't keep all your eggs in one basket. You spread them. But one thing is very interesting. A lot of people don't think about is gearing.
Yeah.
When you use somebody else's money to make an investment, right? Now you'll think, why would somebody else will give you money to invest? But banks do.
Why would
Banks do. So if you buy a property, you take a mortgage. So let's say you buy a property of £100,000, you put 25,000 from your cash and you put 75,000 mortgage. And then when the property is going to appreciate, the whole 100,000 is appreciating.
Yeah.
Your mortgage is fixed to 75,000. So let's say it becomes £200,000. You still have to pay the bank £75,000 and you have your whole £125,000. So return on your £25,000 becomes much bigger when you add gearing to your investment.
Yeah.
So you build a goal, okay, if you want to buy a buy-to-let property, then you save the money over a period of time and then get into those.
Yeah. So hopefully we have given some insights and information to help our listeners start their investing journey.
Yes, as I say, you need to start investing today.
It's already too late.
Too late, yeah. If you haven't, you have to start investing. Start with
Yeah.
as much as you can. Keep doing it regularly. Build it in a system. It's not one-off thing. It's a system. You have to keep investing.
Yeah.
And happy investing and have your time back.
Well, for women,